Hello again from Core Wealth. I'm Kevin French. I'm going to be talking through what's been happening in financial markets up to the end of February 2025. Tit for tariff. That's what we're seeing around the world as Trump imposes tariffs like he did on China, a 10% tariff and another 10% levy. China retaliated by imposing 10% tariffs on agricultural and energy imports into China. Canada and Mexico have also had tariffs of 25% imposed on them in a bid to try and get them to control the drugs that are coming across the borders from their countries into the US. The European equity markets are really running strongly after years of quite mediocre performance. This has been driven by investor sentiment improving, attractive valuations, companies delivering some really good earnings, and potential intervention from the European Central Bank to try and stimulate the economies there. On the back of this, we've now seen 10 weeks of positive returns in a row from the European equity markets. The honeymoon period is over for the new president in the US, and with all these tit for tats on the tariff side of things, there's a lot of uncertainty happening. Most recently, the Consumer Confidence Index was down in the US. Equity markets are down. Inflation is starting to or raise its head again, and this could mean a delay in further interest rate cuts in the US. All things that the consumer is not too happy about. February saw South Africa being under a lot of scrutiny, both globally but particularly from the US. This was on the back of the land expropriation bill being signed by the president. Our budget was delayed because the finance minister was going to propose a 2% VAT increase, which most parties in Parliament were not happy with. And so it was a really noisy month. There was aid that was being cut by the US that previously would have come to South Africa, all negatives during the month. The interesting fact, though, is that our stock market was flat for the month, and the Rand, usually a quick reactor to any sentiment, was actually slightly positive against the dollar in the month of February. February was an interesting month with some negatives on big markets like the US and Japan, leading to developed market equities being down for the month. Global property up quite nicely, emerging markets slightly up, and global bonds up quite nicely so far this year, catching up some of the losses they've made over the last 3 years. But the real place to have been was in European and UK equities, as you can see, up really strongly at the moment. And this was the switch that we spoke about earlier in this video. So our markets were actually quite subdued in the month. Equity markets flat, listed property slightly negative, and bonds only slightly positive. But what's more interesting for me here is looking back over the last year. Equity markets over 22%, listed property and bonds also up high teens. And our currency has actually strengthened against all three major currencies over the last year by over 3% and almost 7% against the euro. And then from a longer term perspective, South African equity markets up 15.2% over the last 5 years. That's more than 10% ahead of inflation per year over the last 5 years. So some really strong real returns coming through, and we'll see that later in our portfolios. So let's have a look at how these markets have translated into performance for our clients. And here we're showing our UK sterling models, global strategies for clients who think in sterling. And you can see the colored sections just indicate that we've outperformed the peer groups that each of those strategies compete against, which is important for us. And interesting, over the last year, our most aggressive strategy giving 11.5% return in sterling terms, so a healthy year, and our most defensive strategy still giving a good return of almost 8% over the last year. Our global strategy for US dollar investors is shown here on the slide, and we can see over most periods outperforming the peer group. The only period where we've seen a slight underperformance is the growth strategy over the last year. And we've seen some underperformance here as we've had an underweight exposure to the US and emerging markets and an emerging market overweight. However, despite that short-term underperformance, the long-term results are really what's important for us and our clients. And we can see relative to the peer groups, all of the strategies outperforming quite nicely and some decent absolute returns on top of that. Here are the core wealth models for South African investors. In rands, And lots of green on this graph, just showing consistency of outperformance of the peer groups. The interesting thing for me is over the last 5 years now, seeing these strategies delivering some really good absolute returns. During the Zuma years, all funds struggled, although we managed to outperform our peers. The absolute returns were relatively low, and you can see that in the 10-year number. But if you look in the 5-year number, returns of between 7 and 8% ahead of inflation. So really growing clients' wealth well. We have some concerns around US investments at the moment. The equities are very expensive. The slide on the left just shows that. The green dots, if they are close to that dark blue line, then they sort of averagely valued. If they're very much higher than that, and especially when they start getting close to the 30 times level, they are very expensive. And we know that when investments are that expensive, history has shown us time and time and again that the future returns are very low. NASDAQ 100, we potentially below 5% returns over the next 10 years. Whereas the mid-cap shares, the S&P mid-cap, is pretty much on average. The graph on the right shows you times in history when the bond market and the equity market have moved more in tandem. So when the blue lines are above zero, they are moving more in tandem. And you don't actually want that. You're buying bonds to give you some diversification. And we've seen at the moment that the US bond market has not given us that diversification. And unless that changes, we are going to see fewer and fewer investors in the bond market. A country's currency is one of the measures of how strong that country is relative to other countries. The blue line at the bottom, or graph at the bottom, just shows when the dollar was stronger, i.e. the graph is higher, or not. And this goes back to 1974, and you can see at the moment the dollar is at one of its highest points or strongest points ever in the last 40 years. On the right hand side, it just gives you an idea of the different pillars that influence whether a country's currency is strong or not. And those, you can see, of those 5 different pillars, there's probably only one of them at the moment that is leading to a stronger dollar. So we think that we could see the dollar weakening in the coming periods. Will the US economy carry on growing at the same rate that it has? We think that there's 2 things that stand out quite a bit there. One is the shrinking labor force. It has been shrinking for a number of years, and we think there'll be a further handbrake on that because of the changes in policy around immigration and deportation of illegal immigrants, so less supply of labor. On the other side is that government spending has cumulatively exceeded revenue by nearly 45% of GDP. That's what this graph shows below, over the last 5 years. And with them tightening their belt, as it were, we think there's going to be less spending in that respect to stimulate the economy. Those 2 things will probably slow the economic growth down a bit in the US. So how do the different countries stack up? When you buy a share, you want good earnings growth, and you want ideally as low a price as possible. And this graph, without going into too much detail, we're trying to say, where do we see what in which country? The table on the bottom just shows future earnings growth, and we can see that China has got the best expected growth in profits to happen. Europe is the lowest. But then the orange dots show you whether the market is cheap or expensive. And we've said China's cheap, Europe's cheap, the US and India are expensive, Japan neutral. And of these, you'd probably want to lean towards buying cheap shares that are going to give you really good earnings growth. And of these 5, China is best positioned. Are there some opportunities that may be missed in the emerging markets? This graph just has a look at the US tech space versus the Chinese tech space. Blue line on these graphs is the S&P 500 Information Technology Index versus its Shanghai counterpart. First graph just shows you how much the US sector has outperformed its Chinese counterpart. Second graph just shows you how much cheaper the Chinese sector is, some 60% discount to its US counterpart. And the third one says that earnings from the Chinese companies are actually slightly ahead at the moment of their US counterparts. So what has happened so far this year? Just 2 months in, short period of time, but the US stocks are actually all negative, and the Chinese stocks are all up quite substantially so far this year, just giving us perhaps an indication that is this picture starting to shift, because there's definitely value in those stocks in China. Is MAGA, Make America Great Again, being replaced by MEGA, Make Europe Great Again? This graph just shows you performances so far year to date of the US, down, it's negative so far this year, versus France, Spain and Germany, all up significantly. And we alluded to some of this earlier in the video. We're not saying that this is a definite long-term trend, but markets do correct through time. And this may be another area of opportunity that investors have overlooked who've only just invested in the US for the last number of years. Thanks for watching. I know it's been a lot of information, but hopefully that gives you a bit more insight into what's happening around the world in the markets. If you have any topics you'd like us to cover, please go onto one of our social media platforms and just let us know, and we'll try and cover it in one of our future monthly wrap-ups.